People always ask me for the secret to getting rich, and when I tell them the truth, they usually do not want to believe me. They want a hot stock tip or some complex trading algorithm, but the reality is that wealth is built on boring consistency and avoiding stupid mistakes. Most people think you need some crazy strategy to invest real money, but you actually just need to understand the plumbing of the financial system. What is the difference between index funds and mutual funds versus ETFs anyway? Each of these are different but similar investment vehicles with their own pros and cons that can make or break your retirement. We hear these terms get thrown around a lot on social media, and actually a lot of people mix them up and end up paying the price. I know it can be confusing because the financial industry loves using big words to make themselves feel important, keep you in the dark. I actually have a degree in finance, but to be honest, I did not even learn the most important parts of this stuff in school. When I invested in ETFs for the first time, I learned much later on that ETFs did not have one really important feature that I wanted for my life. So I had to switch everything over to index funds, and it was all kind of a massive hassle that cost me time and energy. I want to save you all that trouble today because your time is the only asset you cannot buy more of. In this video, I want to share everything I learned with you so that you can be more informed before making any investments of your own. If you want to learn the difference between index funds and mutual funds and ETFs and which option makes the most sense for your wallet, then keep watching. Before we get started, go ahead and hit that subscribe button because my channel is all about money and investing logic for people who actually want to win. I know it is going to help you learn a ton about how the world actually works, so make sure to subscribe and hit the notification bell for new videos every single week. Let us get right into the math and the psychology of it all. I am going to start with mutual funds because they have been around the longest and they are the grandpa of the group. Mutual funds came way before index funds and ETFs, and the earliest known version was supposedly invented way back in the 1800s. They were created as a way for a bunch of regular people to pool their money and make investments together like a big financial team. Mutual funds offer three major benefits that we need to look at. The first one is convenience. By investing in a mutual fund, you get to own a bunch of different stocks all in one easy package. A mutual fund could have hundreds of different stocks in it, but you only have to make one single purchase. In a world without mutual funds, if you wanted to have, say, 100 different stocks in your portfolio, you would be in trouble. You would have to make 100 separate purchases, which means you pay trading commissions 100 times and waste hours of your life. You would be sitting in front of the computer clicking the buy button 100 times like a robot. That is incredibly inefficient, and life is too short for that kind of busy work. But by investing via a mutual fund, you get instant ownership in all the stocks the mutual fund already owns. And owning a lot of stocks all at once gives you diversification, which is the second major benefit of mutual funds. Diversification is a strategy that reduces your investing risk by spreading out your eggs, so one bad break does not ruin you. Instead of having all your money in one single stock, which is the equivalent of putting all your eggs in one basket, you spread it out. You spread out your money across many different industries and companies. That way, if one of the stocks in the mutual fund totally crashes and goes to zero, you will still be fine. Because each stock is only a small portion of your overall portfolio, and the winners will eventually outweigh the losers. Mutual funds typically consist of around 90 stocks at a minimum, so they provide a lot of diversification that would be hard to replicate. The third benefit of mutual funds is that they are managed by so-called investment professionals. So rather than try to find stocks on your own, you have some super smart guy in a suit who supposedly knows what he is doing. He picks the stocks for you, and you just sit back and relax. So mutual funds offer convenience and diversification and access to professional money managers. But that does not mean mutual funds are 100% amazing or even a good idea for most people. Convenience and diversification are definitely good benefits, but the problem with professional fund managers is that they charge a lot of fees. When some really smart, well-educated professional is picking the stocks for your mutual fund, that is called active management. In return for managing your money, actively managed mutual funds charge an annual fee of 1 to 2% of your account balance. That might sound small, but let us do the actual math because the math never lies. At 2%, if you invested $10,000 in a mutual fund, $200 of that goes straight into the fund manager's pocket. And even if the manager makes poor investment decisions and your account balance actually goes down next year, you still get charged that 2%. You could literally end up with less money than you started with, but the fund manager would still get paid millions of dollars. They get paid for their services regardless of whether they actually made you any money, which is a pretty sweet deal for them, but a terrible one for you. And even if you find a fund manager who has done really well for a couple of years, their performance usually does not last over the long run. Statistically, almost no one beats the market consistently over 20 years after you subtract those high fees. Over the years, these fees will reduce your nest egg by hundreds of thousands of dollars because of the way compound interest works in reverse. Every dollar you pay in fees is a dollar that is not working for you and multiplying over time. So the vast majority of mutual funds are totally not worth the high fees and the ego of the managers. Then came the hero of the story, which is the index fund. One day, a guy named Jack Bogle got so sick of mutual funds ripping people off that he invented a whole new category. He called them index funds, and they totally revolutionized the investing landscape for the average person. Unlike traditional mutual funds, index funds are what we call passively managed. This means that rather than paying an expensive fund manager to do active management, the fund follows a fixed formula. This formula totally eliminates the need for some guy in an office to make buying and selling decisions based on his gut feeling. The formula that it follows is based on an index, and that is where the term index fund comes from. An index is just a representative sample of the stock market used as a tool to quickly measure performance. Rather than looking up thousands of stocks individually, an index is just one simple thing you can look up to see how the world is doing. If you are not sure what a stock market index is, make sure to check out my other videos for a deeper dive. Jack Bogle created the first index fund in the 1970s, and it mirrored the S&P 500 index. The S&P 500 is one of the most widely followed indexes in the world because it tracks the 500 biggest companies in America. Since the fund simply buys whatever stocks are in that index, the fees are much lower. You are not paying for expensive fund managers or fancy offices or television commercials. The Vanguard S&P 500 Index Fund charges an annual fee of only 0.04%. That is peanuts compared to the 2% those other guys are charging. Now, it is important to remember that index funds are actually a type of mutual fund. All index funds are mutual funds, but not all mutual funds are index funds. An index fund will clearly state that it tracks an index, and it will specify exactly which index it tracks. For example, if you look up VFIAX, it says index fund right there in the title, so it is pretty obvious. And if you look at the prospectus, it specifically states that the fund employs an indexing investment approach. It is designed to track the performance of the Standard & Poor's 500 index, which is a widely recognized benchmark. It does not get any more obvious than that. But for a mutual fund that is not an index fund, the prospectus will say something very different. It will say that the advisor independently selects and maintains a portfolio of common stocks. That is code for we are going to try to be geniuses and charge you a lot of money for it. So that is how you distinguish between mutual funds that are index funds and those that are actively managed. Moving right along to the ETF, also known as exchange-traded funds. ETFs were introduced about 15 years after the first index fund, and they are very similar in theory, except for one major difference that affects how you interact with your money. With index funds, you can usually only buy and sell shares once a day after the market closes. But with ETFs, you can buy and sell your shares whenever the stock market is open, like you are trading a regular stock. Even though an ETF is a basket of assets, you can trade it as if it were a single company stock. A lot of times you will hear the terms ETFs and index funds used interchangeably by people who do not know any better. But they are not exactly the same thing. If you wanted to invest in the S&P 500, you could either go with an index fund like the Vanguard one, or you could go with an ETF like the SPDRS and P500 ETF. The question you have to ask yourself is, do I actually need the 24/7 tradability that an ETF offers? Or am I just good with an index fund that settles once a day? In my experience, being able to trade ETFs all day really does not help you achieve long-term success. Because the fact that it trades like a stock and you can watch it go up and down every second is a problem. It really only encourages impulsive buying and selling, which is the enemy of wealth. Human nature has a very strong tendency towards gambling behavior and looking for excitement, which is obviously the opposite of smart and patient investing. So I personally think ETFs can do more harm than good. For a lot of beginners, why even deal with the added temptation of seeing the price flicker all day? If you are not sure whether you should go with ETFs versus index funds, I would recommend index funds. They are essentially the same underlying assets, but you won't have the temptation to gamble. Most people only need to buy their shares once and hold them until they retire, so you really do not need the ability to sell at 10:30 in the morning on a Tuesday. Another reason why I love index funds, and this is a huge reason for me personally. The reason why I switched over from ETFs to index funds is because index funds offer automatic reinvestment. This makes it really easy for you to save and invest without even lifting a finger. Index funds allow you to set up a recurring monthly deposit from your checking account. They will automatically buy more shares for you every month like clockwork. The best part is that there is usually no additional charge for doing this. This is a free automatic reinvestment feature, and it makes it a no-brainer for your habits. You want to automate your good habits and make your bad habits difficult. ETFs do not always offer this feature in the same way. If you wanted to contribute more to your ETFs every month, you might have to log in and buy more shares manually, which means more work for you and more chances for you to talk yourself out of it. And sometimes it means you have to pay trading commissions every time, which adds up. So I hope you have a better understanding now of mutual funds and index funds and ETFs. Mutual funds came first and offered the benefit of pooled investing for the masses. Then index funds came along as a special type of mutual fund with much lower fees. They use passive management to track the market instead of trying to beat it. And finally, the ETF came on the scene, which trades like a stock and offers convenience. But it lacks that simple automatic reinvestment that makes index funds so powerful for long-term builders. For more beginner-friendly info on stock investing, make sure you check out my other videos. If you are new to the channel, hit that subscribe button for new videos every week. If you have any questions at all about what I talked about today, let me know in the comments. I will be sure to get back to you because I want us all to win. Always remember to go after your dreams unapologetically and live life on your own terms. Wealth is not about having a lot of money, but about having a lot of options. Don't be the person who works for money their whole life. Be the person who makes money work for them while they sleep. Stay boring, stay patient. Peace.